Welcome to Griffin Uncut, our podcast on the inside of the fintech ecosystem in Europe and the UK. I'm David Jarvis, Griffin's CEO and co-founder, and today I'm joined by Paul Forster, who is the co-founder of Indeed.com, and today perhaps better known for his wide portfolio of angel investments, one of which includes Griffin. So we're very grateful, Paul. Thank you for joining us.
Thank you for the invitation. Lovely to be here.
So with that, I thought maybe we could start with a little bit of personal background. And I think obviously kind of would love to hear from you a little bit about the Indeed story and how you became an entrepreneur and how you found your co-founder, how you settled on Indeed, and the journey that you went on.
Yeah, absolutely. So my co-founder, Ronnie, and I, we were at business school together in 1994 at INSEAD in France. And
before we even go any further, how did you end up at business school? Why did you choose business school?
I was in Southern Africa. I was working in the mining industry.
Okay.
And actually got stabbed. I almost lost my life
Oh
in
my God.
Johannesburg.
Okay.
Decided maybe I didn't want to stay long-term in South Africa.
Okay.
So survived after 10 days in hospital. Don't usually include that story in my bio.
I was going to say, we've known each other for quite a while now, and I've never heard this before.
Yeah, it was a car hijacking, but survived that. And I thought, okay, I'm not going to run out of the country. I'm not going to leave immediately. But then about a year later, I decided to, maybe go live somewhere else. So I went to France, did an MBA, wanted to kind of get out of the mining industry as well. And so that's why I ended up doing that. And then after INSEAD, I got a job with the International Finance Corporation in Washington, D.C. So that took me to the U.S. Ronnie went off to Singapore and worked for an entrepreneur there. I spent 3 years with the IFC. We were hiring financial analysts. I was going through stacks of resumes, paper resumes.
Yeah.
Thinking, there has to be a better way to do this. It was the early days of the web around 96, 97.
Yeah.
And so we decided to set up a financial job site, Ronnie and I. And
just very specifically, you were thinking to yourself, the sort of the wedge that I'm going to target here is financial analysts and financial roles, not
financial professionals.
The universe of
financial professionals.
Yeah.
So it was broad. It was that broad, but it wasn't all jobs.
Yeah.
So we built that business. We were a little late to the party. The .com boom and bust was on our doorstep. We didn't raise venture money. We did manage to get it to profitability and sold the business in 2003. So I guess, one of the lessons was there wasn't enough product differentiation because the job boards like Monster and Hot Jobs and Career Builder were already out there.
Yeah.
So we built it. It was a successful business, but it was never going to be a big business.
Well, you say that, but I mean, objectively, the exit that you achieved was a pretty good exit, given, I mean, you raised a little bit of outside capital, but not
none.
a lot.
We didn't raise any,
Amazing. Amazing return.
We got it to sort of multiple millions of value, but it was never going to be a big business. But, the great thing about it was we got the domain knowledge from that. And also, I think it gave us the DNA of being super lean. We were really, really lean, obviously not having raised any outside capital, just using our own money. Yeah. And that helped us with Indeed. So after selling that business, we started Indeed in 2004.
Oh, sorry. I had this was a separate. I didn't realize it was a precursor business. I thought this was the business that became Indeed. So
it almost is like that.
Yeah.
I was just talking to Ronnie the other day about it. That it does in some ways feel like a continuation of the same business. It wasn't. But it was the same co-founder structure.
Yeah.
Ronnie and I were 50-50 co-founders. And but it was obviously Indeed was a much more powerful product.
Yeah.
We were applying the Google model we were the first really to apply the Google model to classifieds.
And what do you mean when you say applying the Google model to classifieds?
So both in terms of the user experience, it was a consumer product. So we were providing the most comprehensive and relevant job search results to job seekers. So it was analogous to Google in the sense of being a comprehensive search index.
Yeah.
But we were doing it with classifieds, and all that data was behind forms, so it wasn't something that Google was indexing properly.
Yeah.
And in addition to the consumer experience, there was also the ad experience, the we applied an analogous model to Google AdWords, pay-per-click auction model
Right.
for the advertising side. So those kind of the two aspects that were really following, and that probably one of the most powerful business models in history.
Yeah.
And we were able to find a vertical that Google wasn't really interested in, wasn't a very interesting engineering problem to solve, very messy indexing, those kinds of jobs from behind search forms. And so we built that business. We raised one round of venture money. We raised $5 million Series A from Union Square Ventures and New York Times and Allen and Company in 2005. That took us to profitability and built that business and ended up selling it in 2012. So that was, a pretty exciting journey.
And that was the big return, really, for you. One of the things that I think is remarkable is, I mean, you talk about the sort of the DNA of leanness that you had in that first business, but you carried that over to Indeed, right? It was a really, really scrappy operation for a very long time. How do you enforce that? Like, how do you actually drive that? How do you decide what you're going to put resources on and what you're going to just allow to be chaos, basically?
I think we were conscious that we needed to build an enormous amount of traffic. We had to get a very high, millions and millions of users in order to be able to sell this to employers. In the early days, we monetized with Google AdSense on the pages, and also we sold to job boards. But in order to sell to employers, we had to have sufficient volume of users to be able to drive traffic to individual job postings to make that worthwhile. So I think we were conscious of keeping it lean until we really built a big consumer service. And but luckily we were doing it at a time when it was possible to build these massive networks of users relatively cheaply, in fact, for free. The traffic, most of it was generated from Google organic search results.
Yeah.
We built, many, many millions of users without paying for any, marketing. And then, so we kept it lean until then. And then once we were able to monetize by selling to employers, we were able to scale up really fast at that point. But I think it helped, having the background of having built a business without any venture money and keeping it really lean. We didn't use recruiters to hire staff, so partly because it felt a bit contradictory.
Yeah, I do feel that would have been.
So it didn't feel like we wanted to eat our own dog food. But I think also, in addition, if you don't use recruiters, it provides natural friction to hiring, so you don't hire as many people as quickly.
Yes. Yeah.
And we kept a very, very high bar to the quality of people we hired. I think one of the VC that was on our board from Union Square Ventures, Brad Burnham, once said, he kept referring people to us to hire, and we didn't hire them. And he said, well, you wouldn't even hire your mother. So I think we got to a point. I don't think we ever got to hyper growth year over year. We were just really consistent compounding. It was 100% growth year over year, year in, year out. And
that eventually turn into a very large number.
Turns into a big business,
Yeah. Going back to the sort of creation of Indeed, right? So you have this initial business and it's successful, but as you say, you also have a market that's quite competitive. Why did you go and do it again, right? I mean, obviously, you've sort of answered the question a little bit, which is you had a different product strategy. But was it just the product strategy? How did you make the decision that you wanted to go sort of back into that industry with conviction that you would have a very different business at the end of it?
I think it felt like business. It felt like something that we hadn't properly done. I think first time round, I think we always had the vision of providing a service for all job seekers and all employers, a universal service, but we just didn't have the right product strategy.
Yeah.
And I think that once we saw, Google was going public that year in 2005, that was the year after we started Indeed. But I guess we saw this was a much more powerful product strategy to attack the same problem, to attack the problem of being able to universally connect job seekers and employers.
And then going back to, I think, Ronnie specifically, So you go to business school together. You then part ways. What was the what made you think, Ronnie's the person that I want to work on this with?
Actually, there's a funny story. That was our wives.
Oh, yeah?
Because they were friends when we were at business school, and they used to do art together, and were quite close.
Mm-hmm.
And my wife said, you really ought to do something with Ronnie. He's a pretty smart guy, and he's looking to start a business. So actually, they came to visit us in Washington, D.C., and then we started talking about opportunities.
Mm-hmm.
And it went from there.
A lot of wisdom in one significant other, I've found.
Exactly.
So moving beyond Indeed, you now do a lot of, or maybe not do a lot of, but you have done quite a bit of angel investing. You have a reasonably large portfolio, I think, at this point. At what point did you decide to sort of hang up your hat as an operator and focus more on investing as what you wanted to do?
After selling Indeed, I never, at that point, was ready. I wasn't ready to start as a founder. I got into investing fairly slowly. I was living in Cambridge at that point. I lived there for about a decade in Cambridge, England, and started investing in that investment community. And sort of it built from there. I had capital to invest. I thought, okay, this is something that is going to be fun to do. I've really enjoyed working with founders and felt like this was a good way to deploy capital, hopefully get a return out of it, but also stay involved in the startup community and do something really exciting and have the variety that you don't have when you're a founder.
And how do you think about your role? Because, for lack of a better term, I would call you a sort of a super angel. Seedcamp has once called you a one-man fund. But you're not a traditional angel where there's a degree of sort of spray and pray, small tickets, maybe less involvement. And you're also not a fund. So you occupy this quite sort of unique position where, you can write fund-sized checks. You don't, sort of as a general rule, except where things are hopefully going well. But you are very, very hands-on with the businesses that you tend to work with. Certainly, you've been very hands-on with us. What is that dynamic like? I mean, you're one of very few people who does this, certainly in this country.
Well, it varies a lot. It provides a lot of flexibility. So in some cases, I'm more like a VC.
Yeah.
In other cases, the majority actually, I'm more like an angel, although writing larger checks than typical angel investors. The instances where I've been more like a VC, I've taken a much larger chunk of the cap table than an angel would, so often sort of 10% or more of the cap table, and then taken a board role, so either a director or observer role on the board. And that's often been sort of opportunistic. I don't compete with VCs for deals. It's usually where there's some sort of unusual alignment of circumstances. So, for example, founders who've had very bad experiences with VCs and would rather find alternative sources of seed capital. There's one instance where a VC lost interest in a business, didn't have the patience, and I ended up buying their stake in an early stage company for pennies on the dollar, and that company has ended up doing really well, and I'm an observer on that board. And then, so it's every situation is different. There are many cases where I'm more like, more passive, but sort of engage with founders on an ad hoc basis and try to help them where I can. But usually larger check sizes and more involvement than a typical angel.
And then when you think about your portfolio, is there a sort of thematic consistency to it in your mind? Like what makes something interesting? I mean, there's obviously a little bit of kind of what makes something interesting to you on an ad hoc basis, opportunity for you to get, potential pipeline deal flow out of wherever this goes. But then also, retroactively, as you look at the sort of deals that you have done, you might not necessarily have gone into it with a thematic focus, but does one stand out kind of after the fact?
It tends to be application layer software. I don't do, that's pretty broad.
Yeah.
But I don't do a lot of, I haven't done any hardware.
Yeah.
I do some deep tech. I've done some, like in the Cambridge ecosystem, I've done some pharma and biotech, but that's not sort of my specialization. I've done quite a bit of fintech. I don't do a lot of, it mostly tends to be enterprise or B2B. I don't do a lot of consumer. That's more because I just don't see that many really interesting consumer deals. Perhaps that's because I've been investing more in the UK and Europe, less in the US. In terms of the businesses that I find interesting, it tends to be, I look for market opportunities. I understand one's big market opportunities or credible wedges into big markets. I look for founders that are sort of ambitious and focused and have products that are well differentiated versus incumbents versus markets that are not too crowded in terms of startups that are in the same space. So there's a few different things. I mean, it's hard to articulate exactly what one's looking for. There's an element of knowing it when you see it. But those would be some of the themes. Obviously, AI is the big one now. I could try to stay open-minded and look for things that excite me when I see them.
And then you tend to get involved very early in companies' lives. So usually seed. I don't know how much pre-seed you do. Obviously, pre-seed has changed hugely in the sort of last couple of years relative to what it looked like in the UK, certainly when we started Griffin. How do you think about, where you do take on a more active role initially in helping companies? I mean, one of the things that we've always valued about working with you is that you have a sort of, because of the size of your portfolio and its breadth, you have a almost preternatural ability to see around corners for the mistakes that every early stage startup is bound to make if they're not warned off of it. How do you think about the point in time where it makes sense for you to step back a little bit from that more, not operator, but sort of very hands-on investor role?
Well, that's a very flattering comment.
You're welcome.
I remember one bit of advice. I mean, one of the things I've learned about being an investor is that providing unsolicited advice to founders is generally
I think you're
not a good idea.
You're really good at doing it, though. I mean, the thing that I always appreciated about you is you don't. It's never a command. You just sort of floated across the table, and you would say something like, "I'm just a little bit concerned about this," right? And then it leaves the founder to decide how they want to deal with that thing that's now sitting in the open, right? It doesn't force them to take action, but they also can't totally ignore it.
Well, that's nice of you to say. I remember one bit of advice that I did provide very early was before I invested. I said, David, I'm concerned that the cap table is it may have errors in it. You used a template, I think, that another VC had provided.
Yeah. Well, I think you not only did you tell me that, you told me the sort of the customer experience as a VC looking at this cap table is not good. Like, you should invest in making this a better experience for me. And I was like, you know what? That's actually a really good point. That's very interesting. I hadn't thought about it from that perspective.
That's interesting. My recollection was like, you weren't very keen. You weren't very keen to do it, and then afterwards you said, actually, no, you were right. There were mistakes in that previous one.
Yeah.
But I think that I think that providing unsolicited feedback is often not well received. But I think that if you listen to founders and find out, where their concerns are, and just listen, and then they will ask you questions, and that's solicited feedback, which tends to be more productive in most cases, where it's every company has different needs, every founder has different needs, and just trying to be a sounding board is kind of the best approach. So I try to do that, but you have to be. One of the things that's tricky about transitioning from being a founder to being an investor is actually being able to take that step back and realize that at best you have influence. You don't have any control. Don't try to have control. It doesn't work. And try to be helpful, where you can, and you may have influence if you're lucky, but you've got to be comfortable knowing that you may actually not have any influence after you've made an investment, and be comfortable with that.
Yeah. And then, so we started now to talk about our relationship. So let's dig into that a little bit more. So you came in very early at the seed round, and then invested again in our last round. I would describe both of those investments as extremely contrarian, i.e., you came in at a time when almost no one else was able to or willing to. What do you think that you and I mean, like, again, just in the context of where the business is today, Paul's investment in the most recent round was sort of followed by like a 5x of kind of revenue growth. So like seems to have been a great time to enter the company. Obviously, like future trajectory still being worked on. What do you think you saw, or what sort of gave you the conviction to make those investments at a time when objectively, like the rest of the market was not inclined to do so?
Yeah, well, the first one, I think that the institutional seed community had a lot of reservations because I guess a certain segment of them were not able to invest by their policy, by their mandates. They were not able to invest in a company that wanted to be a regulated bank. So that cut out a bunch of the market. And then I think that there was another segment that were nervous about the whole journey of trying to be a regulated bank, insofar as it's kind of the inverse of the classic Silicon Valley startup model, which is sort of launch fast and early, iterate, get to product market fit. And this is kind of the opposite. It was sort of build a theoretical bank, as I like to think of it.
Yeah.
Build this incredibly sophisticated financial model that not only sort of models out hypothetical revenues and expenses, but also all the complex tiers of regulatory capital. And then in addition, build a team so that you're credible to the regulators, which is expensive, and build a full board of directors. So you're building this whole
cost base
before you've got any sort of products to sell.
Yeah.
And I think that is completely contrary to the typical sort of VC tech investment model. But of course, the beauty of it is that there's this moat that you're creating that other businesses don't have. So you have to have the foresight to be able to see what the end game is. And I don't know whether I had a lot of foresight, but I did. I was conscious of the fact that even though I was investing and getting a big chunk of the cap table early as a lead of the seed round, that it would be diluted.
Yeah.
That I would, that percentage would go down because it is it does require a lot of capital.
Yeah.
Maybe not a lot compared with AI businesses today, but so it depends what you're comparing with. But compared with the sort of typical SaaS businesses of the previous generation, it requires a lot of capital. And so, I was just lucky that other VCs were not going to take it. But I think one did almost take it, and they had some technical reason why they couldn't do it, and then I stepped in.
We won't drag their name through the mud. There were two who so one wanted to, but had a legal reason that they couldn't. But they were convinced that they could figure out an out from that, and then that turned out to just be a colossal waste of time. And then another that gave us a yes, and then literally at signing.
I remember that one. Yeah. And then the second time I invested, it was a very different set of challenges. The regulatory risks had gone to a large extent. Griffin had become authorized as a bank, and the risks then were more on the commercial side. So I think that in the early months after the authorization, the ramp of the commercial side was slower than we would hope. The revenues were growing more slowly, and so I think there was a lot of hesitation from investors as to whether this could really scale commercially. And but I could see the green shoots. I could see that this was going to work, and so it's been really exciting to invest second time around. And now it's one of my more significant investments in my portfolio. So yeah, very, very excited to be on the journey here. And then I was on the board for 3 years, which was nice. Really enjoyed that. It's tough being a board of a regulated bank.
It's a lot more work.
Is a tough world.
Some of your other board roles, I suspect.
But no, it's challenging for you guys. But I think that one of the things that attracted me to invest in Griffin in the first place was your background, David, which is a very unusual combination you have of having an engineering background. You're sort of a natural product leader, but in addition, you've got this sort of passion for the regulated banking environment that I think that's an unusual combination. So, and I think you need that combination to be successful to lead a bank. You've got to have, because I think that I'm an investor in Monzo as well, and I think Tom had the product chops to make this really successful, but I don't think he was so excited by the regulatory side. He didn't have your passion, I think, perhaps for the running a regulated bank, and so it's a really unusual combination. And then with Alan as well, it's really it's always been great to have a co-founder, CTO, who's got that kind of engineering chops and credibility and leadership track record in as CTO and co-founder of a successful tech business, Circle CI. So I think the team was a big part of it as well, and it's great to see the success now.
Well, I wanted to ask about that a little bit. So, I mean, you just referenced Alan. Obviously, like, I think the first time you start a business with someone, you don't necessarily know how it's all going to play out, right? And for a huge number of businesses, co-founder dynamics are actually the thing that kills the company, right? Or certainly can cause a tremendous amount of havoc. And although Alan and I had worked together before, I don't think either of us could have known exactly how well we would work on a journey like this. And it does turn out that, like, we have, like, unquestionably the right pick, right? Like, we can finish each other's thoughts. We can, like, come to the same conclusion completely independently. I have, like, total trust that if Alan is in the room and I'm not in the room, he will say exactly what I was going to say, potentially better sometimes. How do you think about the sort of co-founder dynamic when you're looking at other deals, other investments? Because I mean, often you're sort of and I'm always conscious of this, right? You're principally dealing with the CEO, but there is always, not always, there are sole founder companies, plenty of them, but there are often, you know, other people there who are as important, but who you're meeting kind of afterwards, who can have a profound impact on the kind of outcome of the business. How do you de-risk that?
Well, first of all, I do tend to invest in businesses that have multiple co-founders. I have made some investments in solo founder businesses, so I've made some exceptions, but it is a lot harder to do the heavy lifting when you're on your own. So I do try to find businesses, as most VCs do, that have 2 or more founders. And, you know, it is really difficult to evaluate the co-founder dynamics when you're just having a few meetings with them. And obviously it helps to be in person. You can kind of read people a little bit better that way. But it isn't easy. I mean, generally you can see some sort of positive signals where you see there's kind of energy that is generated between individuals, that's where there's kind of a natural chemistry between founders, but it's not always easy to see that. Looking for complementary backgrounds is kind of an obvious starting point. If there is a natural division of roles, that helps. So, for example, if there's a kind of a person who's naturally going to be the engineering leader in the organization. And you can kind of see that from the differentiated backgrounds. But, CEO founders come from very different backgrounds and functions, and there's no kind of obvious pattern there. They could be engineering backgrounds, marketing, sales, finance. You see successful CEO founders from very different backgrounds. So it's hard to figure it out in a very rigid way. Sometimes you see negative signals. You see friction. It's rare that you see that, though, where there's sort of... Sometimes you see the pattern where the person who has the CEO title, you think, actually, it should be the other guy or the other woman who is the more natural
I would rather
CEO.
be working with you.
Exactly. And you think, why is that? But that's very rare.
Yeah.
But it is, it's hard. You can't really tell.
Yeah.
In a few meetings, you can't really tell too much. But obviously, it's a big problem for a lot of companies getting that right.
Yeah. And then thinking about the trajectory that we're on, right? So, as you said, obviously, knock on wood, we have a very good relationship with the regulators. I would like to think that regulatory risk is not a kind of key concern for us. We've got very strong product market fit. We have very strong go-to-market fit. How do you think about the kind of the big challenges that you think we're going to run into over the next 12, 24, 36 months as we really transition from being, an early stage firm to more of a kind of growth profile entity?
I think it's going to be strategy focus. What should the focus be? What should you do? What should you not do? I was listening to your 2026 roadmap podcast.
And thinking, oh God, he's trying to do too much.
Well, just the sort of opportunities are huge, right? Because you've got this, we've got this very exciting platform, and there's so many different directions this could be taken, so many different products, different technology challenges. And you were talking about sort of agentic banking. Yeah. You were talking about stablecoins, and these are all really exciting opportunities, but it's difficult to do everything.
Yeah.
And just deciding what to do and what not to do, and not getting distracted by kind of the noise out there.
Yeah.
Everybody's going to ask you what your AI strategy is, which reminds me of the past, which is, I remember, I'm old enough to remember when people said, "What's your internet strategy?" Mm-hmm. What's your mobile strategy?
Yeah, what's your cloud strategy?
Yeah, and what's your crypto strategy?
Yeah.
And when you look back and you think, well, they were kind of the wrong questions.
Yeah.
And because these technologies become embedded in everything.
Yeah, they become everything. Yeah.
Exactly. The right question is kind of, what is your strategy? What's your product strategy? And then the secondary question is, how do those new technologies, how should they be used or not used?
I think there's probably something in making sure that you're, these platform shifts don't happen very often, but when they do happen, they are, they completely shift the foundations of all commerce, basically, right? And so the thing you want to de-risk is this founder, this entrepreneur, this team doesn't have their head stuck in the sand, and that they understand the significance of this platform shift, and they're not kind of holding out against it. I mean, one of the things that's been interesting for me as a founder with the AI shift has been, in the early days, you did have, these kind of founder CEOs having these conversations with their entire company where they're like, look, you guys can get on board or you can get fired. And initially I thought, it's a bit strong. And then it was a couple of years ago now, I did end up having almost that exact conversation with our leadership team. And I was like, okay, cool. Like, we're now at a point where this is going to irrevocably change everything. And like, I'm not going to say that if you don't embrace this, I'm going to fire you tomorrow. But I want to be really clear that like a year from now, if you haven't leaned into this really hard, you're not going to be here. And it's fascinating now to watch that sort of pervade through the entire company. We have one of our best engineers started as like a categorical skeptic, and he is now like a total convert, like a complete convert. Has changed absolutely everything about how he works, and it's just absolutely wild to watch. I mean, you're right. I think the question of like what is your AI strategy is the wrong question. But equally, if you're investing in a business and they're saying, "Oh, it's just a fad," you'd be like, don't know about that.
Yeah. Well, I remember when people were worried about Facebook's future because they didn't have a mobile product or strategy, but they fixed that by buying Instagram. So sometimes you have to bring it in from the outside, the new technology.
Again, I mean, very super topical, right? Because Zuck had this conversation with the entire company where he said, like, we are now a mobile first company, and you can get on board with that or you're fired. Right?
Yeah.
So,
but there's so much opportunity out there now. I mean, I think that you've got your original roadmap, and then you've got all these new opportunities. Obviously, stablecoins is really, really exciting opportunity.
Yeah.
But I think that's going to be the challenge. How do you weigh up all these opportunities, and there's only certain amount of resources you have, and just trying to decide where the priorities are? I would say that's going to be the biggest challenge in the near term.
Yeah, I think that's right. I mean, what I've learned over the last 5 years is there is a lot of value in we don't have a CPO, so Alan and I sort of share the CPO kind of mantle. There is a lot of value as CPO in casting our eyes quite widely and being aware of everything that's happening and having a sort of theoretical strategy for everything that we could do. But what I've learned is, I don't want to deploy any resource against something unless I'm going to be able to drive it all the way to completion in a timely manner so that it can generate real kind of commercial impact for the business. And that hasn't been consistent. In the past, I definitely sort of like hedge my bet. So you should spend a little bit of time on this. You should spend a little bit of time on that. And the end effect was nothing happened. I just consumed people's cycles and consumed people's time. And so now, I'm like, here are the things that we are going to do in exactly this order. And if we, fourth on the list is not going to get resourced until one of the first three is complete, right? Because we can really only be making progress on right now for where the organization is. We can only be making progress on three big initiatives at once.
Yeah, it's best to do a small number of things really well. I remember before I originally invested that one of the VCs told me they didn't want to invest in Griffin because the problem was that you wanted to do everything.
I mean, that's true.
So
it is true.
Maybe one day. Yeah.
Yeah. No, I mean, I think, and it's the irony and the frustration, right? Is like what we have ended up doing today is we've done one thing really, really well, right? Which is this kind of like API first, embeddable bank accounts. And that turns out to be very diverse in its use cases, but it is essentially a singular product. But I think, it is a platform business. And at the end of the day, the kind of embeddable bank accounts are not really that monetizable. Like, yes, there's good money to be earned. Obviously, our competitor Clearbank basically runs with just that product and is at 90 million in revenue in the UK alone. So they're doing quite well. But it's everything that comes after that that's really interesting, I think, because that's where the real money comes from. But all of those other spaces are very competitive. Stables, cards, FX. I mean, they're all very competitive spaces. But once you have someone's bank account, your right to win in all of those spaces is sort of incontrovertible, right? It's just you're at that key sort of product fulcrum point. So the platform thesis was always the right thesis, but it is a matter of if we don't have that core thing, we have no real right to win in those other spaces. So it makes sense that we've been laser focused on just getting this one thing done to a point of excellence, where the sort of win rate versus competitors, organic growth, net revenue retention is like amazing. And now we can begin to do those other things. But again, I think we also need to be very, very deliberate. We want to be really good at everything we do. And so that maybe means, only being really good at one thing this year.
What will the next product be? Will it be cards or?
It will be cards, and I think stables will be a very fast follower. Because we're just doing so much in the stablecoin space now already. We're banking. I mean, we have a lot of deals that we will close that are involving banking issuers, banking businesses that are doing stablecoin orchestration, payments, companies that are at the application layer that are doing stables kind of natively. So there's like the market pull on that is immense. And then the market pull on cards is also very, very large, just because cards are the dominant consumer payment method today. And so I think that's how I'm thinking about it just at the moment. It's like cards is the thing that is getting engineering resource allocated now. Stables have no engineering resource, but we are doing commercial deals where we're leveraging the existing product infrastructure and we're not doing any custom engineering work. And then as soon as some of our existing projects draw to a close, like our direct debits work, for instance, then we'll be in a position where we actually have the engineering capacity to begin to put that into stable work.
It's going to be an exciting year.
It's going to be a really exciting year. It's going to be an exciting 24 months, I think. Thinking back, if you were once again sort of like building Indeed today, it's a wildly different market landscape. What would that company look like if you were starting it now? What would you do differently?
Well, I think one thing that we wouldn't do differently is the philosophy of putting the user first. We provided the most comprehensive and relevant search results for job seekers. And that's something that that product strategy of putting the user first, as opposed to, in the case of recruitment, the payer is the employer.
First, yeah.
And that's always the temptation to sort of put their interests first,
Yeah.
which is a short-term strategy. So that's something that wouldn't change. I think the one thing that's very different now, two things are different now that come to mind. One is AI, obviously.
Yeah.
There's lots you can do now that was impossible before.
Yeah.
So, for example, using voice for gathering data on both sides, being able to sort of just have natural conversation to say what kind of jobs you want, or for a recruiter to say what kind of candidate they want. And there are companies out there now doing that kind of thing. And I'm sure Indeed will too. And then another one, of course, is matching, just LLMs making that kind of automated matching easier and more powerful. So there's some elements of technology that are different now and more powerful. But I think one thing that's harder now than it used to be is building networks of millions of users.
Yeah.
Luckily, Indeed was built at a time when it was possible to build a big consumer service.
For attention was less brutal.
Yeah. SEO, it's still possible to do SEO much, much harder.
Yeah.
So I think so some things are easier now and more powerful, and some are harder. And I think I think that's one of the challenges that a lot of consumer AI companies have is, how do you build a business to scale with a reasonable cost? Because you've got the cost of user acquisition as well as, of course, the compute costs.
Yeah.
And that'll be interesting to see. That's a very different game from the one that we played back in when we started Indeed.
And then obviously looking beyond how excited you are about our next 12, 18, 24 months, what else is just super exciting for you right now? What are you just really sort of enjoying looking at? And yeah, I mean, there's obviously a tremendous amount going on in AI generally, but what excites you these days?
I've been doing more in the health space, which I think is interesting. So as I said before, I didn't do a lot of deep tech investing, but more recently I have. So I think that's interesting, both in the sort of biotech pharma space, but the intersection of kind of digital and bio is interesting, and then AI comes into play there. So I think there's a lot of really exciting opportunities there. But I'm open-minded. I'm looking at all verticals and all segments, and just seeing what new things are out there, and excited to continue investing.
Paul Forster is open for business. Thank you, Paul. It's great to see you. It's great to catch up, and appreciate you having us.
Thanks, David. Great to be here.
Cheers.
Cheers. Bye-bye.